for anyone looking at providing for their future, you must take a long-term view on things. And I think that what really excites us about this type of real estate is you can sit on this property for a long time, and fundamentally it's going to grow in value.
How's it going, good people? My name is Eish, and welcome back to MoneyMetEish. Today we've got a really special guest in our video. I'm joined by the CFO of Orbvest, Clarke. I'm going to be asking him a couple of questions. He's going to answer them. He's going to tell us exactly what Orbvest is and how they operate. So, if you like this video, hit the thumbs up, subscribe down below, and ring the bell to be notified when we upload more videos. And let's get into the video.
Over the last 2 centuries, it is estimated that 90% of the world's millionaires have been created by investing in real estate. And most will agree that owning the local medical office building or rehabilitation hospital, or even a prime CVS pharmacy building, would be a great place to grow your long-term wealth. The fact is, most of these assets are mostly out of reach to average investors. Not only is it super complicated to source, evaluate, and manage these highly specialized commercial assets, but it requires significant amounts of capital. Orbvest provides the solution. We make investing in the most sought-after medical real estate simple. Orbvest is not a REIT or fund where fund managers decide for you. We carefully curate medical office buildings that we think you will like, grade them according to the risk level, and you get to choose where you place your hard-earned dollars. We take the unknowns out of the equation, put the power back in your hands, giving you the ability to build your own portfolio over time, selecting the state, the city, and the risk level that works for you. Our investments generate regular dividends paid on a quarterly basis, creating annuity income and long-term wealth. But the really exciting benefit of owning a part of an Orbvest medical office building is that you get to share in the capital growth of the building over a 3 to 5 year investment term. Our overall internal rate of return, or rather average income per annum, on investments that we have sold at the end of their term has returned a minimum of 11% per annum to investors. So how do you get started? Log on and register your details online. If you need help, keep an eye out for our useful assistant that will pop up to assist you, manned by one of our helpful support team. Select the building or portfolio of buildings that you would like to invest in. We do the rest.
Hi, Justin. Thank you so much for joining me on the call today. I'm really excited to get a chance to chat with you.
Jared, great to meet you too. Yeah, and thanks very much for giving me the time.
We do like to try and broaden the horizon as well, more than just stock investing. So I'm really excited to get a chance to look at Orbvest and then present this opportunity to the audience as well. So I hope they'll get a lot of great insight into the company, how it operates, and why you chose medical real estate in the USA.
I guess that's a great place to start. I think first of all, let's just look at the US. And the US is whatever you think of the US, it is still the world's largest economy. I was there, obviously spent quite a lot of time there, but quite recently on all the news that we get on this side of the pond that it's an economy going into recession. You would never believe it when you're there. You can't get into a restaurant. Everything's chock-a-block full. Flights are full. I think you always hear people talking about the fact that there are adverts on every second storefront saying help needed, sign up bonus, etc., etc. So, it doesn't feel like economy on the brink of recession, although we'd actually like it to go into a recession because it'll help our cause. And I think the other thing is that, the US dollar is still the world's reserve currency. And I know there's a lot of discussion around de-dollarization, but it's just not going to happen, for the foreseeable future, certainly in the way that people are projecting it to happen. So that's I think, the US consideration. But most importantly, the US is actually quite unique in that it has substantial tailwinds driving demand for this particular niche of real estate, the medical real estate space, like nowhere in the world. It is a whole bunch of converging fundamentals that are driving the demand for this type of this niche of real estate.
I was having a look at a presentation that you did before where you spoke about converging factors in the aging population where you decide to operate, as well as a growing population. And I guess in a lot of ways, the US is one of the only countries that actually has the ability to grow at the rate that it does population-wise, since there are so many people that are looking to move there in ways that other large population countries just don't have.
Yeah, I think you touched on a few points there. The aging demographic, and it's not an aging demographic that is dangerous like China or like Japan, for example. It is a growing population, and it's a very big country, and some of the states are benefiting from the growth that you mentioned. And I think one of the fundamentals that we look at is states that are growing. The likes of Texas, Florida, Georgia to a certain extent, and there are a few others, particularly the red states that are very business friendly and the like. The Carolinas and even states like New Mexico and the like. So yeah, that's one of the fundamentals. And I think the other thing you touched on was the growing population, the aging population. And, this is quite a phenomenal number, but, they are projecting, we're sitting now around about 60 million people over the age of 65. And by 2060, it's going to be just about kissing 100 million people that are over 65. And why that's relevant, Jared, is that the data shows that people over 65 spend on average about $19,000 a year on healthcare, whereas those sort of in your age group below 45 spend about $4,300 a year. So you've got these two awesome converging waves moving towards particular states. Aging population move to the states where there's lower taxes and warmer climate, which just happen to be those states that I mentioned. And at the same time, there's more older people. And at the same time, there's a third thing, or there's a third and a fourth. I call them the drivers. And the third thing is that the US is spending more and more every year consecutively on healthcare. And it is projected that this could approach kind of 30% of GDP, which is an enormous number, around about $6.5 billion by 2030 will be spent on healthcare. So there's another
government driven. Sorry, Justin, is that government driven spending, or is that like out of pocket or insurance spending?
The fascinating thing about the US economy, it's a little bit like the South African private healthcare sector. It's driven entirely by insurance companies. So a medical insurance company, if you're a corporate, you have to take out insurance for your clients, but you can go to whoever you like. And about 90% of the population are covered by some form of insurance. So different to popular belief, the majority of people have private insurance in the States, which is much more expensive than ours. And obviously the healthcare is pretty much first world. But yeah, I think that's a very important stat. It's not government spend, which is, you've effectively got one source of revenue here. You've got hundreds of insurance companies that effectively do the healthcare insurance we have here. And also, let's not forget that the insurance companies are doing their damnedest, like we call the medical aids in South Africa, but they're doing their damnedest to try and control costs, even though every year, no matter what they do, the overall spend goes up. But the fact is that in order to control costs, they're trying to keep people out of the hospital systems. So if they can send you to a theater where the procedure happens during the day and you go home during the day, it's substantially cheaper for them to do that, and perhaps even maybe nurse you at home. So there's this massive drive out of the hospital system. And I think that's another interesting stat that I have to throw into the pot for you. And that is that, if we go back to around about 1995, 70% of the total amount of revenue that was generated out of healthcare was in the hospital system. So 70% of all of the expense was hospital expense. And the rest was sort of your private GP rooms, or what we call medical offices. By 2019, that had converged and it was 50-50. So 50% of the entire spend of the US is for procedures and healthcare that is done in a medical office, not in a hospital. The other thing that's bizarre that I almost didn't believe when I saw the data, but the procedures that were initially done in a doctor's consulting room or doctor's theater would be laparoscopic, microsurgery. Now they are doing hip replacements in a day surgery. So you go in the morning, you have your hip taken out, replaced with a prosthetic, and you go home in the evening. How bizarre is that?
Wow. And I mean, I thought, because I had a surgery here, and I thought the fact that I was like out in 3 days was incredible. I thought, wow, they really want to get me out this bed. So Orbvest has 40 medical buildings currently.
Yeah, we talk about our core portfolio. Obviously, going back 8 years or so, there was a lot of experimentation. And I think that, we talk about there being two Orbvests. There's the Orbvest where we were doing these sort of opportunistic buildings, getting involved with developers. We don't do that anymore. It's too risky. We focus on what we call core plus buildings, that are buildings that are already stabilized, that are pretty much sort of 90% tenanted, where there's stable income. So, we've kind of tried to de-risk, these properties. So we say that the core and core plus properties are around about 30 properties. And then also bear in mind, we've had a couple of exits, altogether about 10 buildings that we've sold at the end of their periods. So far, so good. We managed to maintain over 11% IRR on the stuff that we've sold. But I think that right now that, it's stuff that we're selling at the moment is obviously going to be a bit more under pressure because of the current economics.
Do you have any new buildings that are coming up that you want to talk about?
We are, Jared, one of the other things that we're doing is we're trying to move towards getting our investors and our retail investors into a diversified product as opposed to a single building. And I know that this sometimes is hard to understand because people they think they like the idea of investing in a single building. But the challenge is that, there's always investing in real estate is not a straight line. There always are bumps in the road. So we kind of are trying to encourage people to get into our diversified product. And what we've done is we've effectively taken a little bit of each building that was either bridged or that was bridged, and then we effectively put it together into one little pot. And we call this ODH. And to give you an idea now, the returns that we've paid have been consistently 7% or over on this ODH product, paid quarterly. And of course, that's effectively underwritten, if you want to call it that, by over 100 doctors practicing in 9 states. So it doesn't matter if a hurricane happens or, whatever happens, there's always diversification. So there's a wide spread of doctors, as opposed to you getting involved, for example, in our Medical 42, which there is still a little bit left, not much, but something. It's a great building in Atlanta with 7 tenants, fully occupied building, but it's got 7 tenants and they're all dentists. And if something happens and those dentists in that building for some reason can't practice, call it a flood or a tornado or whatever it is, then all of a sudden you have disruption to your rent in that building and you're going to have no dividends for a quarter or two. So, the diversified product is great for retail investors. But yeah, to answer your question, we still have single buildings, but there's, we're trying to move a little bit further away from that.
And the ODH, I guess, in a way, you could sort of look at it as like an ETF in a way of the buildings that you offer.
100%. You still have the benefit of these hyper-focused medical office buildings with all the tailwinds that I mentioned. The only difference is that it's not a broad fund with hundreds of properties and you don't know what's in it. It's only got performing medical real estate in that fund. And I think that's what makes us very comfortable to put retail investors into it.
Speaking about a situation where people are not able to practice, how did the buildings perform during COVID?
Yeah, quite interestingly, we did boast that during COVID, we had very little disruption to dividends, but we did have some sponsors that continued to pay out when perhaps they shouldn't. And then after COVID, there was a hangover. So yeah, I think that overall, the big corporate tenants, they were able to absorb it. We had some tenants that obviously, you remember that the hospitals might have been closed to procedures, but some of those procedures had to happen and happened in the medical office buildings. People were uncomfortable with going to the hospitals. So medical offices mostly stayed open. We had a bit of disruption to the dentists because a lot of dentists stopped practicing for 2 or 3 months. And then the smaller dentists obviously couldn't pay. But I think overall it was probably the least disrupted of any commercial real estate that I've ever had any contact with.
Investing in Orbvest, how long is the term? And if, say, we are not able to keep our funds invested for a long time, life happens, is there an ability to exit earlier than that term allows?
There is. And just to give you some clarity on how it works, what has happened up till now is people that do want to exit before the 5-year term, provided it's a good building and there's lots of demand for it, you effectively let us know, and we just send it to the rest of the investors in that particular building, and they normally soak it up. They normally absorb that existing interest. Remember that the returns are paid in 2 forms. One is the cash that's generated out of the rentals, which escalates slowly over the years because you go up by your normal escalation and any value that we can add to those rentals. And then at the end of the 5-year period, when the building is sold, there's a capital gain. And the capital gain then is split with the investors, which takes the return from your, whatever it is, 7% up to your 10 to 15 or whatever it is, IRR, depending on the building and how well it's exited. So there is demand from investors that want to buy at par, in other words, the same price you paid when you bought the investment, as it gets closer to the 5-year period, because that's when the return gets bumped. And if you take your overall IRR and you buy it in the last 2 years, the chances are you're going to get a much higher return. So there's an incentive for investors to buy late on in the 5-year period. So I hope that answers the question.
Yeah, it does. On the debt part, how much of the building is being financed through debt? How much of the buildings are being financed through investors on the platform?
The banks don't like to go, don't like to have too little equity in the project. We don't like to go above 60-40. In other words, 40% equity, 60% debt. It works fantastically well in a low interest environment when your debt is low. But at the moment, with debt running at about 7% and we're buying buildings at a cap rate of just over 7%, there's not a lot of leverage you get out of your debt. But normally there's leverage you get out of debt, so debt is good.
All right. Can you explain the cap rate to me like I am a 5-year-old, please?
Yes.
What exactly is that?
You can get super complicated with cap rate, but basically cap rate is as if you were going to go and buy the building for cash without any closing fees. That is the return that you would get to be able to put back in your pocket every year. So that's the simplest way of explaining cap rate.
All right, great, thanks. So basically, if I'm understanding it correctly, you would want a larger cap rate.
Absolutely, yeah. So the larger the cap rate, the cheaper the building is, because more money you get out of what you paid for it. If it's a 10% cap rate,
yes. Oh, I understand now.
If you're paying more cash, without any fees or anything, you'd be getting 10% every year you can put back in your pocket. And interestingly, what happened with medical after COVID, because of the good performance of healthcare, people started piling into medical assets, and the cap rate started to come down to the late 5%. So the rates were 5%, and now obviously with the interest rate increases, those rates have gone up, sort of pretty much in tandem with the inflation, with the interest rates. So now running at 7%. Now, the difference between a building, if you work out, take a $10 million building at a 5.5 cap rate versus a 7.5 cap rate, or in the case of that building that I mentioned in Albuquerque at an 8.3 cap rate, it's a massive discount that you're buying that building at relative to what it would have been a year ago. And I think it makes sense that if you think about where you'll be in 5 years' time, if you anticipate that the interest rates will come down in the next 3 to 5 years, which is the general consensus, then your cap rates will compress as well. So you're going to get this very nice capital appreciation. Inflation is a very interesting one because there are escalating costs on operating these buildings. But the crazy thing is that the type of leases that we like to sign are what we call triple net or absolute net leases, which means, Jared, that the tenant is responsible for all of those costs which can be pushed through to the tenant. In other words, a full absolute net lease means that it would typically be, if you think about the local McDonald's on the corner, that would be a triple net lease. They basically pay the landlord a fixed rental, but they're responsible for everything: the aircon, the maintenance, the mowing of the lawn, the waterproofing of the roof, the repainting, whatever it is. That's a full triple net lease. And so to a large extent, our buildings are protected. However, we've had some very interesting wildcards in Florida, for example, where insurance on some of the buildings that aren't triple net has escalated by a couple of 100% because of the hurricanes. So this is why I say things are not necessarily always a straight line, but but the triple net leases, and we always try and get triple net leases. And when we roll over tenants, we get them to sign a triple net lease as opposed to a typical gross lease.
At the end of the 5-year period, is it an option for the investors to decide maybe we want to stay in the building a little bit longer, or is it always like hard deadline, 5 years, that's it, we're out?
Ideally, we would not like to sell after 5 years if the conditions aren't right. And normally we have an extension period of a year where it's up to our discretion or whatever. But we had an example of Medical 7, a building in Texas that came up to its 5-year period, and we went to investors and they said, no, don't sell. So we effectively refinanced it. So we went to the bank and said the building was worth 10 million. It's now worth 13 million. Give us $1 million out and we'll give that back to the investors. So what that meant is that the investors got a bit of their capital back, but it pushed their returns up to between 9 and 10% cash on cash. Now you're getting a really nice, 10% cash on cash in the US, people kill for that sort of return on that type of stabilized asset. So we've had we've effectively taken that thing and reset it for another 5 years based on that principle. And I think we'd like to do that in future. In fact, even better, we'd like to take the investors and the building and rather roll them into a portfolio of other buildings just to give them additional protection.
That's sort of shepherding them away from single buildings and more into the ODH products.
Yeah, no, absolutely.
Okay. What criteria do you look for in buildings when you go into them? I guess it's a two-part question. That would be the first part. And then how can us as external investors looking at buildings to buy on the Orbvest platform, what do you think are some things that we could look out for to help us decide which building we think would be a better investment?
Well, Jared, I think I can give you first of all, just a general property view, having spent all my life in this real estate industry. I think you've got to consider your investment in two different ways. What are you investing for? Are you investing for a stable return, or are you investing to speculate on a high capital growth? And my first steer would be, unless you have surplus money that you can afford to play with, then rather invest in income generating real estate. And so I think that's a generic thing. But coming back to our buildings, I think you've got to look at the income of the building. So is the income secure? And that is really what it's all about. Because if you look at, let's say, a state, if you are in a state that has a very big market for your type of properties, if a tenant goes bust, let's say, or for some reason doesn't renew their lease, you need to find that there are a dozen other doctors that want to take up that space. If you're in a very small market, then you will find that's not the case. So the first thing is size of market. So if you're somewhere in Florida, chances are there's always massive demand. If you're in the back of Utah in a small town, you'll lose your one doctor tenant and then there won't be another one to fill the space. So I think that's the first thing. And then the other thing is length of leases. Is critically important. If you're buying a building with short leases, there is a lot of risk that some of those tenants might not roll over. In other words, might not sign a new lease. So look for long, what we call WALTs, or weighted average lease terms. And so we try and push our WALTs out as long as possible. And in fact, our investment committee requirement is 5 years. So because we're investing for 5 years, the leases must be an average of 5 years. And I'll give you an example. Medical 43 that we have just got under contract now is in a medium-sized city, but quite a fascinating place that we really like at the moment, Albuquerque in New Mexico. And they have an average WALT of 10 years. That means that the leases are longer than 10 years in some cases and a little bit shorter than 10 years in other, but the average is 10 years. So you've got an average of 10 years from a big surgery center that has 5 different operating theaters in your building that have a very low probability of going bust for the next 10 to 15 years. So, I think you can understand.
It sounds like a great position to be in.
Yeah. So it's basically you're buying the cash flow for the next 15 years. And then the only other thing to look at then would be the debt. And what is very critical at the moment in South Africa and some of the markets in the world, the debt, it's very difficult to fix your debt, or you have to pay a big premium to fix your debt. Whereas in the US, everyone fixes their debt. So when we buy the building, we fix our debt for 5 years. But you also got to look at the rollover, because at the end of 5 years, now there's obviously an element of risk. Can that building be refinanced? And once again, it comes down to where's it situated? What do the leases look like? And of course, who's in the building. If it's got a bunch of office tenants, it's going to be less easy to lease than a bunch of medical tenants. And it'll be much easier to finance if it is full with medical tenants as opposed to office tenants.
On the topic of rands, have you found specifically now with the rand near touching all-time highs not too long ago, have you found that it has had a negative impact on people deciding to send their money over?
Absolutely. People are very scared. But the interesting thing is since I've been involved, I've noticed this trend. And in fact, I've been guilty of it myself. Where you think, I'm not taking my money out now. It's 12 rand to the dollar. It's crazy. I'm going to wait for it to get back to 10. And then it goes up to 13, and we see it all the time. So I think we've got, in 1995, I remember the number particularly. It was $3.58 in 1995. And we know it's just touched on $20. So, it's only going in one direction. Yes, sure, there might be bumps along the road and there'll be appreciation and depreciation, but very clearly it's getting ridiculous, the rate of exchange. And certainly if you take your rands over to America now and try to have a holiday, you'll learn that your rand goes nowhere in real terms.
Even looking at smaller currency pairs. So if I compare the rand with the Taiwanese dollar as well, when we first moved over here, it was a little bit over 2 to 1, 2 Taiwanese dollars to the rand, and now it's almost like 1.6, 1.7. It's lost almost like 40% of the value of the rand while we've been here, which for us is great because we're sending money back home, and it's like, hey, we're getting more money, but it's quite sad.
No, and I think for anyone looking at providing for their future, you must take a long-term view on things, and I think that what really excites us about this type of real estate is you can sit on this property for a long time, and fundamentally it's going to grow in value. So as long as you don't worry about it and you don't need to dip into the money in the meantime. Or, I mean, certainly you can dip into the dividends, but ultimately the value of investment should go up. And so, you just need to say that I'm going to take out a proportion of my foreign exchange allowance if you're in South Africa, and I'm going to put a certain amount into the real estate, and I'm going to close my eyes at the exchange rate, because when you come back in 5 years' time, you're going to say, man, that was a good move, even though it was 30 cents more than it could have been at the time. The fact is that you can never time it.
You did in the intro touch on de-dollarization a little bit. Have you found that has in any way impacted the number of investors that you have, since you have investors coming from all over the world? Has the talk of a BRICS buck, if you would, reduced your numbers of investors from BRICS countries?
No, I think there's other reasons. I mean, at one stage in the very early stages, we had a lot of investment from China, but that's really just the operator. That was the operator in that part of the world that was particularly active at that point. But I think our biggest external source at the moment for this year is probably Israel. And to talk about BRICS, we have some investment from Brazil, and India is growing quite nicely as well now. So I don't think that we're seeing any impact from the story of de-dollarization, and certainly I have applied myself to considering if that is a threat or not. And I don't think it is in the short term, and that's my personal view.
Has Easy Properties ever been in touch with you guys?
Yeah, no, we'd actually like to do something with Easy Properties. We have spoken at a high level with EasyEquities. We've shared a couple of glasses of wine at a conference recently. But I think that their focus seems to be quite different. So at this stage, we haven't managed to get anything together with them. But no, I would love to do something on the EasyEquities platform, platform. I think it's a great business, and I think there's a lot of opportunity to do it. A lot of your guys probably trade a lot on EasyEquities, so
yeah, the majority.
Easy if you've got an account there already, just to extend it. So guys, ask EasyEquities to contact us. We really we should be putting this product on their platform.
I thought I'd play a little bit of corporate Cupid, but apparently I am very bad at being Cupid. So maybe I should stick to my day job. So Justin, thank you very much. This has been incredibly insightful. We've got some great answers from you, and I'm sure the community is going to learn so much from what we've shared with them today. So thank you so much.
Thank you very much, Jared. Nice chatting, and cheers to everybody.
Thanks for watching, guys. If you found this video helpful, please hit the thumbs up and subscribe down below. You can get in contact with Orbvest by following the link down in the description. Fill out your information, and one of their brokers and consultants will get in touch with you, and you can discuss with them whether this is an investment that you would like to make. So thanks for watching, and I'll see you next time.